Well, when I first met Vinay, it was at an ETF conference where I was, or an ARC was, kind of a curiosity. It was in 2018, and nobody believed we would make it. Everybody was curious, how could an active manager work within an ETF wrapper? That's for passive, it's fully transparent. But Vinay believed that we were going to be successful and believed in our transparency, our active, our information flow. And he's run with that with the Tifin companies, very focused on transparency and bringing in intelligent access to especially registered investment advisors and institutional investors. So we were intrigued with his business, or we have been intrigued. We've piloted some of his services and have been very satisfied with the result.
So Vinay, it brings us to you and what you're trying to build. Obviously, there's a lot of money going into fintech, not just from venture capital, but some of the biggest banks, JP Morgan, Visa, doing billion-dollar deals in the last few weeks. So I think of Magnify, your subsidiary, as a sort of Google for investments, but you're expanding into actually selling the investment products. Talk about what you're trying to build, what your vision is.
Yeah, thank you, Sarah, for having me here. Cathie, thanks for joining as well. And you're absolutely right. Look, fintech investment has gone from, VC investment in fintech has gone from 4 billion in 2016 to 8 in 2018 to 35 billion last quarter, just in fintech. But a lot of this activity has been largely focused on payments, lending, neobanking, and what's happening in the space of wealth and investments is still new and still nascent. So Tifin, we think, is part of the solution. We are a platform that really builds fintech products for the world of investment and wealth management. And what we are really doing, Magnify, which is one of our subsidiaries, when we presented it here in August, we had a few 100,000 users, which the number of searches on our platform has exceeded 10 million last year, which is clearly telling us that the marketplace needs a simpler, easier, more natural way to discover, compare investments. And the next natural step for us was to enable action. How can you discover, compare, and then maybe invest, which is what we're doing now with our...
So quick note, this is basically a company where they build fintech companies. So they do the infrastructure for fintechs.
You used to push people after they search stuff to other asset managers and brokers. Now you're going to do it yourself. How do you take your commissions?
Great question, Wilfred. So I think that, this goes back to my academic background. It's pretty clear there's lots of research and evidence that excessive trading hurts performance. And we also know that, guess which segment of the market trades excessively? It's really the discount brokerage audience. Wow. And the discount brokerages, all of them have an incentive to promote trading, whether it's through commissions or whether it's through selling order flow. So we thought hard about how can we build a platform that is really investor focused and encourages investment. So we don't make revenues from selling order flow or from commissions. What we do is charge asset managers, investment managers who access the investors using our platform. And we do that in a very transparent, simple way, where if you go in and search for example, e-commerce without Amazon, you will find the first result sponsored in a very transparent manner. We also have subscription services.
Cathie, wanted to talk a little more broadly about fintech. We know you're a big fan of it across all of your portfolios, and it's been a great play for you.
SoFi is different.
Some of those stocks, though, on simple multiples can look quite expensive, and
yes.
We wondered whether we'd found a cheaper alternative for you. Earlier on the show, we had Bank of America Chairman and CEO Brian Moynihan, and here's a soundbite from that interview.
We are a technology company. We're basically huge, capable technology platforms.
Okay, I heard him say that. They literally asked him, are you a fintech? And he says, we are a technology company. I'm like, bro, Bank of America, why don't you just be straight with people and go, we're not like, my answer would have been something more like, no, we're not a fintech. A fintech is a smaller company that doesn't have the experience of an institution like us. If I were Bank of America, right? Like if I were pitching them, I would go from that angle. Like we actually have way more products and way more servicings. We're not a little baby financial company. We're a big financial company with better options for our clients, right? Like that's the pitch I would have given. But this pitch, in my opinion, was just like dodging the question. Sorry.
Cathie, I'm being a little bit cheeky here, but seriously, would you consider buying Bank of America as a fintech company for your portfolios?
Well, we do. We would not. It's not what we do. We are very focused on innovation and very rapid growth companies. So our revenue growth is north of 25%. So we're not going to see that from the traditional banks. But what we will see is much like what has happened in traditional retail. We have Walmart and Costco and Target. They are doing very well while a lot of the market is hurting badly. So we do think that industries that are going to they're under attack from fintech from many, many directions, no question about it. But the biggest and those who invest in technology in the smartest way possible are going to basically consolidate the industry. We do believe that what has happened to retail is going to happen to financial services at an accelerated rate.
Makes sense.
Cathie, wanted to take the opportunity with you just to ask about some of your other investments. Obviously, a lot of buzz and people pay attention when you come on. You made a lot of news warning about China and have been unloading some of the Chinese names amid the crackdown we've seen from the Chinese government. What do you think is going on there, and what happens to your holdings that are still quite substantial in names like Alibaba? Are you just going to continue to unload?
Well, what you've seen is mostly in the flagship strategy, which incorporates all of our innovation platforms, all of our ideas, scarce real estate, 50 names. And when we see an assault, and I would say it's more on the valuation of many of these names, we will pull out and consolidate towards higher conviction names. In our other portfolios, what you'll see in our autonomous technology and robotics strategy, ARKQ, for example, we haven't done that much except at the margins with those companies that we believe need to expand outside the rest of the world in order to sustain their growth rates. We do believe that China is clamping down. I don't know if it's capital controls. I do know there's a little bit of a retaliation against the Biden administration's policies, which are a continuation of the Trump administration's policies. I think that's been the biggest surprise for China. And I think for most investors, we thought that the U.S.-China saber rattling would diminish somewhat. That has not. What you will not see us do with the Chinese stocks is pull out of those names that are more endemic to China itself. China does want to be a leader in innovation and is very supportive for its companies scaling as quickly as they can internally. What I feel is going to hurt at the margin, though, is any company, and in fact, in their last policy announcement, they said any company with more than 1 million users. And as you know, in China, I think WeChat has over 800 million users. They're going to be under tougher regulatory scrutiny. So I do think that's a valuation downgrade. I think that has happened. And let's see what happens from here. As I said, I don't think China wants to cut itself out of the innovation game. I think it'll encourage it internally, and we'll wait for things to settle down, and then again reopen and allow its companies to scale more into the rest of the world.
What about, Cathie, China's clampdown on Bitcoin? Did that also warrant a valuation downgrade in Bitcoin?
Well, it was the combination of that and the ESG concerns that Elon Musk headlined at one point in time. So yes, there's been a downgrade, but let me give you a comparison. in 2017, China shut down all of its exchanges, the Bitcoin exchanges. And the market went through a big fallout because many people thought, oh my gosh, most of the trading is taking place in China. This is the end. Well, guess what? It migrated elsewhere in the world. Japan, Korea, and Thailand were the biggest beneficiaries back then. And as you will remember, after that, Bitcoin started to scale from $1,000. It was actually less than $1,000 to $20,000 in that 1 year. So I think the same is true with miners. Somewhere between 50 and 65% of all mining, Bitcoin mining, was in China. I actually think it's a healthier phenomenon to disperse that mining. And a lot of it is coming to the United States and moving towards renewables. And as you know, we have just done a paper with Square. We're going to have a conference on July 21st. We're one of the hosts with Square, where we're going to explain how Bitcoin mining will probably become part of utility ecosystems and will proliferate renewables faster than would otherwise be the case. So we're pretty excited by that. And we think that Elon Musk and Tesla generally will become a part of that ecosystem. So we think this is temporary. We think institutions pulled back and said, wait a minute, what do we have here? ESG is top of mind. And I think we're answering those questions. And at this conference, you'll see there could be nothing better than Bitcoin in terms of ESG, governance with the transparency, social. This is a little bit of a different use case, but enabling economic empowerment throughout the world, and environmental. If we're right that this community, Bitcoin community, is very environmentally conscious, as are the institutions, I think that we're going to see all of the E, S, and G answered at that conference.
Well, it's a non-consensus view on certainly on Bitcoin right now, Cathie. But maybe you're reassuring the Bitcoin fans they don't have to hate Elon Musk. Speaking of Mr. Musk, you know I was going to ask you about that and Tesla and your position.
Yeah.
He said this week at a trial, Cathie, that Tesla would die without him. And I'm curious whether you agree and what it says about a company that you value at almost $2 trillion that the CEO says without him would be worthless.
Yes. Well, I think that getting through the 08-09 near bankruptcy was Elon Musk brute force, determination, and creativity, ingenuity. And I believe also that it's move up to this point, he has been very critical, especially around the move towards autonomous. I know most people don't believe that that's going to be successful, but we believe it's going to be very successful. And he has been driven and focused and has not let short-term oriented shareholders divert him from that mission. So I do think, just like Amazon, if Jeff Bezos had not been there, think about all the years. I remember I suffered with it.
But what about going forward?
But all the years, Jeff Bezos, during the tech and telecom crash and for, I think, through 2006-07 after, he was saying, we are not going to be a profitable company. We are going to reinvest all the upside from revenues into the business, and we are going to take the lion's share of this business. Not only that one, and AWS. So these leaders who are willing to buck up against their largest shareholders and say, no, we must invest now if we want to capitalize on this exponential growth opportunity. I think I put Elon, Jeff Bezos, Steve Jobs in that category. You know, Apple certainly would have disappeared were it not for Steve Jobs. So these are very special visionary leaders. There are not very many of them. They don't come around. There aren't this big a set of opportunities either. We think there are more now than there have been historically because of all of the innovation evolving. But I understand what he says by saying he doesn't like to be a CEO, but he had to be. And I agree with him. I do agree with him.
She didn't answer.
I wanted to come back to Tifin and your...
Because she didn't answer going forward, and now they're off the topic. I'm kind of bummed about that. Like, what if he left today?
And I wondered whether you were outright critical of some of those apps, like, for example, Robinhood, but many others too, that are incentivized by driving volumes. And what makes you confident you'll attract those retail traders that certainly at the moment are very much engaged by trading stocks, whether or not your platform might offer better long-term returns to them or not?
Yeah, Wilfred, great question. Look, I think Robinhood has built a great business for themselves for sure. And we respect them for bringing many more participants into the markets. It's just a natural evolution that once you democratize access, I think access without intelligence is detrimental. And our purpose is quite different from Robinhood's. What we want to do is to promote investment, longer term trading, and better outcomes. You know, we believe in gamifying knowledge for better outcomes rather than gamifying trading, if you will. But one needs, one step had to precede the other, is my view on this. Today, there are enough participants, even beyond Robinhood. There are many discount brokerages. So the segmentation of the audience across brokerages provides enough opportunities, we believe, to attract folks who probably want to invest more responsibly, more intelligently.
Why did they go back?
And finally, Cathie, I always ask you every time you're on what you think is the best opportunity right now. A lot of these hyper growth names have been hit and have not rebounded with the NASDAQ and some of the mega cap tech names. So where do you see the best opportunity among all the names you like, or even maybe some new ones?
Well, we've had a good rebound. Sorry, but we've had a good rebound since mid-May. I think, and so growth has come back into fashion. I think we're in a bit of a dueling match, maybe risk off right now for the market. You were talking about inflation earlier. If I could just lob in a few examples of major deflationary forces we're seeing, lumber prices today are less. They've dropped by almost 2/3. Since the middle of May. I do believe the Fed today is talking about housing risks and so forth. So perhaps that's one reason. But that's been a severe drop. As copper has come down 10-15%, we are seeing, even in the auto space, the Manheim used car index for the first time in 13 months ticked down. We believed used car prices are going to fall. They've gone way too far, way too fast. And we talk all the time about the deflationary forces associated with inflation. I believe Leah earlier mentioned it. But it's not just on the disruptive innovation side. Are companies causing these falling prices that explode demand? That's good deflation. There's another thing going on. It's called creative destruction. And companies who have not been keeping up with innovation are going and have been leveraging up to buy back shares and satisfy short-term oriented shareholders. They are going to have to service their debt by cutting prices. So I think not only do we have good deflation and bad deflation at work here, but now we're seeing the beginning of cyclical deflation. And I think we're in a risk-off period. I know we got hit today. A lot of growth strategies got hit. There was a shift towards defensives. And I think there's a lot of confusion. But if growth is going to be scarce because inflation is going to come down, our kind of strategies, which generate revenue growth rates in the 25% plus range, are going to shine longer term.
Cathie Wood.
Yeah. Okay.
No, sorry, I didn't mean to cut you out.
I was just going to say, so, our top names, as usual, Tesla's at the head of the pack. Roku is a very important name to us. Square, Zoom, Shopify, Teladoc. Many of them are described as stay-at-home stocks, and why, we're going back to work. Why are you paying attention to them? What we believe is the world, coronavirus crisis changed the world dramatically and permanently. And when consumers and businesses find faster, cheaper, better, more productive, more creative, they're not going back to the old world. So many of these stocks have been cut in half and then some, because there have been algorithms saying they're stay-at-home stocks, sell them. We think that's a mistake.
Cathie Wood, thank you very much. Vinay Nair, thank you as well for joining us from Tifin. And congrats again on the new addition to your board. Thank you both.
Bank of America didn't make the list.
No, definitely.
That was a good one to end it on. Okay, I want to just add some commentary on this because, there's some things that were really interesting on this. Oh boy, that was a priceless way to end that. So some things that are very important to highlight, some notes that I took from what Cathie Wood just said. Number one, I love that she makes it so clear that they target growth companies. Look, Bank of America is a company that is not expected to grow anywhere near like fintechs. That makes sense, right? Because fintechs are starting small and they have explosive growth ahead of them. In fact, Wall Street estimates for growth at a company like a Bank of America right now are 2.8% for 2021, 4% for 2022, 5.6% for 2023. And so it becomes a little bit more apparent that when you compare growth and you're like, wait a minute, that's kind of low, Well, now it makes sense. Why do you think you're paying a lower multiple for the companies? Sometimes I see these threads on Reddit and people are like, oh, if the PE ratio is high, it means it's overvalued. No, it doesn't. It means there's a lot of growth being priced in. SoFi is expected to grow over 51% in the next year. Just to give you an example, let's think of another one. I don't know. What's another one? We could Ally. Maybe you could consider Ally. Ally would be somewhat in the middle. I think I'd love to be able to look up like a Robinhood. See, Ally, not much growth here actually. Pretty low growth at Ally, so bad example. And then I don't use Ally, but I'd love to look at like a Robinhood growth. But I'm sure you can estimate that yourself too. Your expectations are that Robinhood's not going to grow like a Bank of America at 2 or 3%, or it's going to more likely grow in line with what Cathie's expectations are for growth companies, growing more than 25% per year. I suppose an easy example would be, because we talked so much about it, as an easy example would be comparing to, let's say, Tesla, right? Tesla's growth is expected to be 50% compounded growth in deliveries over the next few years. So that's huge, by the way. So anyway, additionally, Cathie Wood reiterated that during tough times, they'd like to consolidate their positions. So what they'll do is they'll have fewer positions. They'll sell out of some positions that they have less conviction in, and they'll add more to higher conviction names. She talked a little bit about China, how she thinks there are a lot of risks with China right now. China is possibly creating some issues, because take a look at this. You've got this as a headline here on Bloomberg: U.S. to extend Trump-era halt on economic dialogue with China. Treasury Secretary Yellen and her staff have no plans to resurrect the regular U.S.-China economic dialogue that governed ties between the two nations during the Obama and Bush administrations. And so here's just another example of Cathie Wood sort of, this was a headline piece on Bloomberg here, but Cathie Wood applying headline news to her investing strategies. She's saying, look, this is a problem. When Biden got in, we thought relations with China would get better, but Biden's actually continuing them in essentially the worst direction, unfortunately. Then we have information about her talking about China. She spent a little bit, actually a good amount of time talking about China and Bitcoin, how China essentially getting out of Bitcoin mining, which previously potentially supplied 60 to 70% of all of Bitcoin mining, which estimates vary on this. So this is Cathie's estimate: 60 to 70% of Bitcoin mining was in China, she says. She says from an ESG point of view, environmental, social governance, right? This is a really, really good thing. Sustainability, transparency, social empowerment, very, very good. So she likes this. I've read her paper with Square on Bitcoin. Her paper with Bitcoin, or about Bitcoin with Square, talks a lot about how we can actually use Bitcoin to help expand our green energy grid. This is something that Governor Newsom, for example, in California, would be very smart to pay attention to. Like, why don't you pay attention to the fact that we could work and incorporate blockchain, incorporate Bitcoin, and utilize this with green energy expansion, so we could use energy that's otherwise being wasted. Wonderful opportunities. This is why I'm running for governor of California. And you should go to my rally this weekend in Bakersfield. Go to meetkevin.com to sign up. And, of course, get 40% off on my amazing coupons for building your wealth. Link down below. That coupon code does expire on the 22nd. You get lifetime access to the programs, and prices will be going up on the 23rd. Now, Tesla. Elon Musk in testimony. I actually pulled up the exact quote so I could get the appropriate context, because personally I believe context is very important. In a statement during his trial about his acquisition of Solar City, he claimed that while the CEO position is one that he doesn't necessarily want, he must maintain the position, or quote, frankly, Tesla is going to die. Yeah, that's not good. That is a very current statement. Elon Musk is saying presently Tesla is at risk of dying without him. When Cathie Wood was just asked about that on CNBC, she didn't answer. She did not answer that. She literally talked about Elon Musk and how important he was during the bankruptcy phase or near bankruptcy phase in 2008, 2009, how important Jeff Bezos was to Amazon when it was, and how they didn't want to be profitable, how they wanted to reinvest everything, how important Steve Jobs was to Apple during the tough times in the 80s and 90s. She told us nothing about her opinion about what if Elon Musk leaves tomorrow. I didn't really like that non-answer. I don't know if she just forgot to get to that part. Now, I'm just going to inject that, yes, I know that Cathie Wood said she agrees with Elon, but keep in mind, she's deflecting the question. The question is, what would happen if Elon Musk left now? And she says, I agree, if Elon weren't there in the past, it'd be bad. So what do you think going forward? But Sarah Eisen had a pretty blunt question, and we got a miss on that one. Personally, if Elon Musk today is saying Tesla's going to die without him, that's scary, right? That's scary to hear. Now, I do personally believe that this could be just an exaggeration of Elon Musk. I do believe that Tesla is in a wonderful position to grow and sustain without him, but I could be wrong. And I'm not trying to undervalue what he contributes, but it just makes me wonder, like, could Tesla continue at this point like Apple continued without Steve Jobs? Or does Tesla need another 10 years of Elon to get to that point of stability? Right? When Steve Jobs unfortunately passed away and stepped down from Apple before that, from Apple, Apple was very, very well positioned. I mean, we were, what was this, 2013 or 14? iPhone 1 was out, iPhone 3G was out, the iPad was out. I think FaceTime was already out at that point. Let me see, Steve Jobs, because FaceTime was 2013 or 14 as well. Oh, wow, wait a minute, never mind. He died in 2011. Oh, I misaligned that a little bit. My bad. Maybe I'm just not remembering when FaceTime came out. FaceTime release date. Oh, see, okay. I just had my dates wrong. FaceTime came out in 2010. The iPad came out in 2010. The original iPhone came out in 2007. So a lot of these really important, like, innovative products came out right before his death, and these were incredibly successful products. So I'm surprised I was a few years off on that one, but I was correct in my order, just wrong in my years. Anyway, then let's see here. We also have this talk about the market, this dueling match in the market that Cathie was talking about. This really has to do with the dueling match of inflation. I actually tweeted about this a little bit. I didn't really love her investment or her joining the board of this Tifin company or whatever. Maybe this is something that. I mean, it's not a company I believe that we can invest in. Let's see, Tifin. Let's see if they're public. I don't believe it is. I think it's way too new. I think it's a larger sort of company that, or sort of a company that develops the backbone or infrastructure for companies like maybe a Robinhood or a SoFi or other sorts of fintechs, or maybe smaller banks wanting to become fintech-esque, but not something that's available apparently to be invested in right now. So wasn't so excited about that. We did talk about the dueling match of inflation, deflation. I do want to give you these poll results. I do want to get more of your votes here. So please go on Twitter and vote. But take a look at this. Will inflation be transitory or not? AKA, are you in camp Sarah Eisen or Michael Burry? And we've got the vast majority of you voting here, transitory, less than 3% in 2022. Almost half of you believing that. Another almost, just over 17% of you, so this would be about 60% of you going for the transitory argument, and then another about 40% of you going for the not transitory argument. But go ahead and cast your vote, because this is very early in the poll, so it could still shift substantially. But cast your poll vote to see how you feel at Real Meet Kevin on Twitter. Okay, Cathie Wood then went back to her argument about deflation and how there are going to be a lot of deflationary forces, creative destruction, innovation. That means older companies are going to have to drop prices to try to be competitive as they potentially go bankrupt and disappear as more innovative and better technologies advance and take over. This is an argument she's talked about many times before. It's not really worth fully rehashing it right now. She did also reference that lumber fell a good chunk here in the last few weeks. I don't know if lumber is exactly the best reference. Okay, look, I want to be fair. I'm a big fan of Cathie Wood, but I'm not exactly sure that lumber is the best reference to say deflation is here because lumber just ran up like crazy. So it's no surprise that the speculative bubble of lumber is now behind us and it's falling down. So I'm certainly, and look, I'm somebody who believes inflation is going to be transitory, that we're going to have a bigger risk of deflation, but I'm not going to use lumber as my as my backup. So as you can see, I have my differences of opinion to Cathie Wood, but in general, I think we're on the same boat. So hopefully you appreciate this insight. If you do, make sure to subscribe. And somebody says that Cathie Wood did say that she agrees with him about, yeah, but okay, maybe. So I just got a notification that some of you say Cathie said she agrees with Elon. So maybe she said she agrees with Elon, but the thing is, her entire conversation was focused on the past. She didn't give us any insights into what about going forward, right? Like what if Elon leaves going forward? And I think that was a little bit frustrating. Which is also what I highlighted in the past few minutes when I talked about it. Anyway, thank you so much for watching this, folks. Thanks for being here. If you have found it helpful, subscribe. Use that 40% off coupon code link down below. Price does go up in about a week. It's actually 8 days. And we'll see you in the next one. Bye, everyone. And we'll see you in Bakersfield as well. Bakersfield, go to meetkevin.com.